All right, we did a sum of the parts analysis for Tesla today. I think it's about time to really take a very hard look at Tesla. The stock is terrible right now, and with these types of situations, you always have to be, really careful. Am I the, the guy on the poker table who doesn't understand what's going on and going to be screwed, or am I the one who knows something that nobody else knows, and therefore I'm going to make money? This is the fundamental question every investor has to ask herself every now and then. We are in this situation right now. The purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. So it doesn't get much more real than this. We haven't really made money for more than 2 years now. We're kind of lingering. We actually went down quite a lot. We recovered some. Now we're losing again. It's a tough situation. Our investors are getting nervous. We're getting nervous. Our leverage is okay. I said that yesterday in the episode. It's one of the things you have to look at immediately when you have a situation like this is your leverage. So that's fine. But of course, we're living in good times. There's lots of opportunity. AI is here to stay. We have a lot of work ahead of us in understanding, in analyzing, in discovering methods to enable embodied decision-making agents. And this is what we're investing in at Launch Capital Partners. So not just that we might lose money with a wrong investment that doesn't work, but we could also miss out on other opportunities. So this is definitely a big wake-up call for us. We don't like diversification. There's of course one thing you can just say, just spread your bets. So we're trying to avoid that. Diversification is basically an admission that you don't really know. And I think given the amount of work we've done, given the amount of attention we're paying towards robotics, I mean, I spent a sabbatical at Stanford. I'm actually still doing them. Just right now I'm in Europe for family reasons, but I'm working hard. You know, NeurIPS was a huge wake-up call. Coral, bars. I am embedded in robotics. I'm not a roboticist. I'm not an engineer, but I think I have a good understanding of what's going on. I started a new series, Foundation Models for Embodied Decision-Making Agents. So we are excited. And nevertheless, Tesla is right now really doing bad. So what we're going to do here is, first we're going to give the good and the bad. So what's good, what's bad about Tesla, and then we're going to do about some of the parts and how we think about the stock. The conclusion is we're going to stay with Tesla because we think there's a lot of upside here. And we believe that Tesla has all the tools in place to actually deliver on the embodied decision-making agents. This is not even one podcast. It's January 23rd, 2024. This is Krimdelko. We are flat for the day. Since the last update, we're down 1.2%. The market is flat. We're down 11.4. The market's up 1.4. We're underperforming by 12.8%. So Tesla is it is the problem, of course. I mean, we actually had a phenomenal performance in NVIDIA, and we have a very bad performance in Tesla, down about 15% for the year. And it's not just that, the way the stock trades every time, today it went up 2% after the open, and it just trades down. There's sellers, everybody takes opportunities. Whenever there's a little bit of a bid, it gets hit. People want to get out. There's sellers everywhere. And, that's of course, that's what I meant with who is the fool on the poker table here, us or them? This is the question. So what we did a sum of the parts. We looked at the situation in terms of, okay, what is this actually worth? And, financially, and then, we can still make a decision. Even if the financials look good, you can still decide not to be invested because, let's say, there's too much risk on the management side, there's too much macro risk, things like that. So what's not working with Tesla? What are the negatives? The negatives are we have slowing demand in Europe. We have problems in China that are compounded. So there's demand, there is issues with real estate. The government is supporting the yuan, so there's pressure on the macro side. The dollar is strengthening. I am in Europe right now. The Swiss franc is as strong as it's ever been, which is not a good sign for the macroeconomy globally. So those are dangerous signals. We have a Cybertruck launch that, in my opinion, just is not going well. And the reason it's not going well is it's slow and the reviews are mixed. Cybertruck is not the kind of product, it's not the iPhone. Now, to be fair, the iPhone, when it launched, was very similar. It didn't work. It was phones got dropped. The internet connection was terrible. You didn't have Wi-Fi in most places, and so on and so forth. So it's not like the iPhone was today's iPhone. And this is going to be also the main argument of this talk is exactly that we think that what's going to save us and make us money is iteration, 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 iteration. Things can get better. This is what we have to believe in. Otherwise, of course, as it stands today, the Cybertruck is at best a niche product. As it stands today, FSD is a nice to have, way too expensive, and there's many other things. So Cybertruck launches weak, but again, let's stay with the negatives. We're going to talk about positives. So the Cybertruck's weak because the reviews are mixed, the range is not very good, the charging time are too long, some of the finishing and this and that, but some of the fundamental promises, though, it's enormously fun to drive, it's very popular, people love the look and all that, that's working, so that's good. FSD V12, so version 12 has been launched. Again, there's no GPT moment here. There should be, but there isn't. And you can scratch your head, Omar Kallo or Omar or whatever his name is, the YouTuber who follows and does videos about FSD. He's right. I mean, look, this is the best thing I've ever seen. I mean, I can drive around San Francisco, no intervention. Well, first and foremost, FSD was optimized for San Francisco. How about New York? How about Naples? I mean, is it really good at total chaos? Probably not. So there's a lot of these types of questions. But again, FSD, of course, end-to-end learning. I mean, we've talked about this in our robotics coverage many, many times. The idea of FSD end-to-end is to have a fundamentally optimized problem through the whole pipeline and to have a recursive improvement embedded in the whole in the actual model, in the algorithm, and the iteration is happening across the data selection, across the model selection, the architecture. Dojo is not just there to train a model, it's also there to train several models and iterate around the model. So everything you could iterate around, the fundamental dogma of machine learning, data, architecture, algorithm, it's going back and forth. It's not just one directional. Tesla understands this. This is the opportunity. So I'd like you to see, I mean, I'm biased. Every time I mention a negative, I'm trying to come up with a positive. But anyway, I'm still with the negative. So the negative so far, macro in China is not good. Macro in Europe is not good. We have a timid launch of Cybertruck. We have a timid launch of FSD. We have interest rates kind of stalling, coming back up in the US. So this tailwind from demand might not be happening that we expected. And then we have Musk also starting to make noise around this 25% he wants to own. It's not clear how that's going to work. But fundamentally, again, we believe that in that particular case, there's only the only way he can get that is if he pays up. So I don't know how that can happen, but somehow he has to pay existing shareholders, compensate them for the right to keep owning more than he owns right now in Tesla. So I don't quite see why that should be negative, but it's being perceived as negative. Tomorrow's earnings call. People are expecting a negative meaning guidance, which will be underwhelming, and we are embracing ourselves for impact here. It's the most likely scenario that you have. They're probably going to guide maybe 2 million cars, which is less than expectation. Stock's going to be down another 10%. So we're looking at the 180 range, maybe something like that now. let's talk about the positives, and then we're going to talk about the sort of the the valuation, which is really what like I said, this hopefully this series can help people who are in the hedge fund business, who are thinking about getting into the business. Hopefully we can be helpful in guiding a little bit in terms of, okay, what should I do in which scenario? This is obviously not investment advice, but we hope to just nudge people. Okay, look, if you're in a situation like this where your main stock is losing money, this is what you should be doing. We're not telling you to buy it or sell it, but we're just giving you some advice in terms of how we manage the situation, right? And getting to the financials, getting to evaluation is critical. So what's positive in Tesla? What's positive in Tesla is, well, it's all the things, all the above, right? We have a Cybertruck launch. The Cybertruck has been launched. The potential for improvement is here. This company has always been able to improve. The first Model S's weren't, that's great. They're phenomenal right now. And we expect the same thing with Cybertruck. Some of the negatives, such as range and charge, will get improved. We will get more range, and we will improve the charging speed. So that is a matter of improvement, and we believe that that's going to happen, like it has always happened with Tesla. FSD is even more important in terms of, or it's even more crucial to actually be able to improve. And the way this is architected, it is designed for improvement. This is the whole idea. This is what we have now is a fleet of people, not big yet, but it's going to grow. They will drive, and we will have data and data and data and data, and then we will have a pipeline that selects the best data to train the best model on the best architecture for fully end-to-end driving. We're already almost there, and it's going to happen. This moment will happen when at some point you will not need to be intervening anymore. And the same way you don't have to intervene with a lot of things that are automatic that I don't know, the elevator in your building or things like maybe stock trading, those sort of things. You don't really care anymore about execution. You just put in an order, and the algos and the AIs take care of execution, those sort of things. It used to be that you call brokers, try to get a good price, all that. So in that realm, I think we will just get to a point where driving will become sort of second nature. Now, of course, regulation and things like that will have to be overcome. But yeah, that's actually one of the negatives. The Biden administration is trying to slow down Tesla wherever they can. We have an election coming up, which is a good thing. And we believe that once the Republicans win, which is very likely, at least at this point, that this antagonistic behavior towards Tesla will stop. Because look, the United States has a choice to be like the Ottoman Empire, a large empire that is anti-science, anti-progress in the name of whatever, or it has the choice to stay what it is, which is, or stay what it has been for the last 250 years. The source of progress, the source of opportunity, the source of experimentation that is necessary for the world to progress. It has a choice. We have the choice in the United States. We can choose this or that. And I believe that we will choose the right thing. So again, improvement, iteration, those are the good things. So Cybertruck and FSD definitely on that front. And they are big margin drivers. So now let me talk a bit about the valuation, the way we think about this stock. I think this is important. And what I mean with that is not necessarily, if I give you now our price target, this is not by any means a suggestion you should buy the stock and sell it exactly at that price. Valuations are thought processes. Evaluation is, it's like when you decide to marry a girl, right? You're not going to do a sum of the parts. You're not going to measure her financially. All her, she comes from a good family, and she's smart, and she can, has a good gene pool. You're not going to do that, right? You're just going to want to marry that girl. But it helps to think through these things. And it helps to have a good sense. I mean, if she is an orphan, then you're not going to have a lot of relationships with her parents. If she is an orphan, she might have a lot of grit, and actually that could be a good thing, or she might not. So anyway, maybe that was a bad analogy. Let's get back to the sum of the parts, the valuation. The valuation is here for us to really understand, okay, what is it actually we're investing in here? So the way we think about this stock is the following. We think that the car business is worth around $200 a share. We think that FSD is worth around $130. The robots are worth around $30. And the energy business is worth around maybe $60. So we get to about $4.20 a share. This is what we think the stock should be worth today, based on an average weighted discount rate of around 19%. So for people who are in the business, for people who understand valuation, hopefully that's enough information. So we use a discount rate of 19%, average weighted, meaning we use different weighted discount rates for different businesses. Musk said several times that Tesla is a conglomeration of startups. So what we're doing is actually taking him by the word. All right, so you have a bunch of startups. This is how we value them. One of them, the car business, is already pretty advanced. It's the largest part, it's half of the company's worth. It's, by the way, what the market today is giving. So the market's pretty good at actually valuing the car business. What the market is not doing is not giving any value for the other businesses. So the reason we're staying in Tesla is because we give the company today some value for these other businesses. And this is the difference. This is how wealth is created, literally. Because we have a conviction about things that the market just doesn't care. And the market doesn't want to pay for FSD, the market doesn't want to pay for robots, and the market is not paying anything for the energy business. The way we think about FSD, cars, robots, and energy, that in itself warrants almost each one its own episode. But what I can summarize here is the following. In FSD, the way we think about it is cost per mile. We think that the cost per mile with electric and full self-drive, whether it's robotaxi or not, the cost will come down simply because with electric, the more you drive, the lower your cost per mile. And the more you drive, lower cost per mile, in particular, you amortize the software on that. So this is the key driver. Now, if we also have a robotaxi, then things change even more dramatically. But that doesn't really, we believe that we could have 0.5 to 1 million mile type cars very soon. And not just, this is not just a hardware question, this is also a software question, because as a person, let's say me, I drive a lot, but to get to 1 million miles takes a long time. With a robot driving, even if I'm in there, even if I have to pay attention to all that stuff, still I'm going to drive even more. It is just a lot more relaxing. Look, autopilot's already, just to give you an example, for me personally, I used to own a BMW before. I would do about 35,000 miles, maybe 40,000 miles in 3 years. Right now, I'm 3 years in and I have 120,000. So 3x with my Tesla, simply because it's electric and I have the autopilot. I don't even have the FSD. And the reason it's just so much more convenient. It's so much more elegant and just less tiring. I drive from San Francisco to Utah. I drive to the Eastern Sierra, to Vegas. These are LA. These are not difficult trips for me because most of the time I'm on the highway and I am obviously paying attention, but it's just so much more relaxing. It keeps the lane for me and does all that stuff. So again, the main driver of FSD is lower cost per mile. Once a company is able to lower something, we're in the sort of Peter Thiel realm, which is how much value are we creating for society and how much can we capture. We have some assumptions on that. In terms of value, we decided the value is simply going to be all those savings per mile. If we can lower the cost per mile, we will, by definition, drive more and save even more, because we drive more now at lower cost, which will drive economic activity, which will drive wealth. And then some of that, 20-30% of that stays with Tesla, the rest goes to society, maybe 20%. This is the kind of relationship you need to have as a company, because otherwise you can, particularly in a situation like Tesla, if we're right and they solve, they can become a leader in self-driving, they will have a quasi-monopoly for all the reasons that we will just discuss in a second. And then you better share a lot of the value with society, otherwise you're going to have a problem. So companies like Amazon, Microsoft, they're being tolerated because they create so much value for society, and no matter what their CEOs and chairmen do, they are being tolerated. So now, why do we think Tesla will succeed? It's because of V12, end-to-end learning, embodied decision-making agents, one optimization pipeline that is working towards solving the problem in an iterative way. With that pipeline, you have the ability to iterate with data, you have the ability to iterate with the model, you have the ability to iterate with all kinds of things. So this is why we think they will get better. This is why we also think they will have a monopoly, because it's going to be very hard to replicate that. So this is how we get to about 130 per share for FSD. On the robot side, we're only at $30 a share because we're very early in there. Potentially, this can be even a bigger business. The way we think about that is, okay, how much people in the United States, industrial workers, cost around $80,000 per year on average. This is the market that Tesla's after. About 10 million of those workers. You can do the math. 10,000 times 80,000 times 10 million is about $800 billion in actual spending. And so that's roughly $1 trillion to spend on workers. That's the kind of spending in the US that robots can go after. Now again, with robots, because they, according to our estimates, will cost roughly, we give them a 3-year lifespan, each robot 30,000 plus about 20% of the cost for maintenance. So you're looking at something like maybe $15,000 per year versus $80,000. So you have obviously a massive, it's almost, it's not 10x, but it's close. And of course, you also have several improvements here in terms of, for example, like I said, it's not just that you're saving now on, it's not just that you're saving on the cost, you're also saving on people not getting sick, damages, accidents. You're improving the quality of life of people. Jobs will change. You know, there will be the robot operators. My brother is a surgeon, for example. He is a leader in the robot operating space. So he's already training to use robots to serve for surgical equipment. I mean, for surgeries, and like he's gonna have a better life. He's gonna make more money and have a better life. And this is a surgeon. So imagine a factory worker whose job is to move one thing from one place to the other, or screw a screw, or unscrew something, or whatever. All of these jobs can be, you know, the less thinking you are, the less cognitive, the less creative, the less unpredicted type of work you do as a human, I think the less happy you are, the less money you make, the more competitive it is. So we can replace those jobs, and that's what the robots can do. So look, I would have to do not just one. I think I could do a series. Maybe I should do that on robots and their potential and how we think about this. But just to be, we gave it a 20% discount rate. We went way out to 2030. So we're taking our, we're giving ourselves 6, 7 years for this to actually start materializing. And we give $30 a share. So it's really small, but it's there. And it's important that it's there. $30 a share is $30 a share. There's 3.5 billion shares outstanding. It's not nothing. Lastly, the energy business. This is pretty advanced energy business. I think I don't want to spend too much time on this. People have spoken about this enough. I think it's there. The demand is there. The problems are clear. Decarbonizing of the economy. We need more storage to be more flexible. We can have load balancing. We can have more renewables. All that stuff. I think I don't need to mention that. So I think to summarize, the reason we come to a like 400 plus type price share target is really because we assign more value for businesses that currently don't get any value. And the reason we do that is because we believe that the possibility of iteratively improving on the software and the robots, and also on the Cybertruck and the new car. So we don't want to dismiss the hardware business, but nevertheless, let's just talk about software now. The software side of things is designed for continuous improvement. This is the key. And this is why we are so excited about this. And this is why we absolutely want to stay with the stock. Lastly, before I finish this episode, one word about concentration. Now, we are, to some extent, a little bit over-concentrated. And the reason we are reluctant to sell is also for tax reasons. I know this shouldn't be even mentioned. I mean, who cares about tax? But it does matter because we're going to get a big tax bill. And to move money out of Tesla just so we have less concentration and pay taxes, it just feels a bit wrong. That's why also we're not considering that, at least for now. If we believe that there is an enormous opportunity somewhere else, particularly with NVIDIA, I mean, NVIDIA has already shown since we bought it, it's more than doubled. And you know, there's again a whole episode to be made how NVIDIA can take advantage of embodied decision-making agents, in particular with their simulation platform. So there's a lot of opportunity there too, but we don't want to now, again, we don't want to spend too much time on that for the simple reason that we think that the NVIDIA business is, I guess there's more upside there that is understood, versus with Tesla, a lot of the upside is misunderstood because it's absolutely mind-boggling. You know, to have a car drive itself around in the city of San Francisco is, I don't want to diminish an H200 GPU, but this is just different level of unexpected, amazing technology, and therefore it's also less priced in the market, and particularly if you then add the robots. Now again, I don't want to diminish the opportunity for Tesla here. For NVIDIA, but we decided that we will grow NVIDIA with its own weight and keep Tesla the way it is. Thank you.